Hi, welcome to the IAS Companion. I'm your host, Meghna. Today's episode is all about the methods of estimating national income. This is a crucial topic for IAS aspirants as national income is a key indicator of the economic performance of a country and it is also a part of the syllabus for the economics section in the IAS exam. First, let's look into the definition of national income. National income of a country means the sum total of incomes earned by the citizens of that country during a given period, over a year. Whereas national income accounting refers to the set of methods and principles that are used by the government for measuring production and income, or in other words, economic activity of a country in a given time period. The first method of estimating national income is the output method. This method measures the total value of goods and services produced in a country in a given period of time. The output method adds up the values of all final goods and services produced in a country, whether consumed by households, businesses, or the government. This method is also known as the production approach. For example, if a country produces 100 units of goods and the value of each unit is rupees 100, the total value of goods produced would be rupees 10,000. The importance of the output method is that it provides a comprehensive measure of the total production in the economy. It takes into account both the quantity and the value of goods and services produced and provides an accurate estimate of the economic activity in the country. This information is crucial for policymakers to make informed decisions on how to allocate resources and stimulate economic growth. The second method of estimating national income is the expenditure method. This method measures the total amount of spending on goods and services in a country in a given period of time. The expenditure method adds up the values of consumption, investment, government purchases, and net exports. This method is also known as the expenditure approach. For example, if a country has rupees 1000 worth of consumption, rupees 500 worth of investment, rupees 300 worth of government purchases, and rupees 200 worth of net exports, the total expenditure would be rupees 2000. The expenditure method is important because it provides an estimate of the total demand for goods and services in the economy. It helps policymakers understand how much the households, businesses, and government are spending on goods and services, and how this spending affects the economy. It is also useful in determining the economic impact of changes in consumer behavior, investment patterns, and government spending. The third method of estimating national income is the income method. This method measures the total amount of income generated in a country in a given period of time. The income method adds up the values of the income received by households, businesses, and the government. This method is also known as the income approach. For example, if a country has rupees 1000 worth of household income, rupees 500 worth of business income, and rupees 300 worth of government income, the total income would be rupees 1800. The income method is important because it provides an estimate of the total income generated in the economy. It helps policymakers understand the distribution of income among households, businesses, and the government, and how this distribution affects the economy. That's it for today's episode. I hope you found it helpful. We put a lot of effort into creating this podcast to help IAS exam aspirants like you. If it was helpful in any way, we would be extremely grateful if you could take a few minutes to leave us a review and rating. It helps other IAS exam aspirants to find our podcast and benefit from it. Your feedback is incredibly valuable to us as it helps us to improve and create even better content for you. Your success is our top priority and we want to be there for you every step of the way. Don't forget to tune in for our next episode, where we will delve deeper into the subject. Thank you for listening.